I'm filling it up too fast.
Yeah.
So we're sitting on the deck at Lean's Lodge. Bob Eisenbeis, David Kotok. We know each other at least a few weeks, I think.
I think that's right.
That's
yes.
right.
Couple.
And we flew up here today,
Yes.
and we're back in Maine.
Finally.
I like your hat, by the way.
Oh, I like yours too.
Well, there you go. Let's do it. That's good. That's good. So we're going to start a gathering.
Right.
We're going to talk about all kinds of things as we usually do. You and I will do interviews of other people.
Right.
I thought maybe it was an idea which you agreed to on the plane, but you were captive. I had you locked in a seat so you couldn't go anywhere. That I could interview you.
Mm-hmm.
You have a distinguished career at the Federal Reserve. You served under 5 chairmen. Was it 5?
I think so. Started out with William McChesney Martin.
Yeah.
Burns.
Yeah.
Volcker.
Don't forget Miller. Miller was in
right.
there a short time. Yeah.
Bernanke.
Yeah.
Yellen.
6.
Yeah.
6 chairs.
Mm-hmm.
Have you ever, in your experience or in history, seen any kind of monetary fiscal combination like this?
Well, the only thing even close was what the response was in 2007-8 when we had the great financial crisis. But nothing like what we've seen this time around in terms of the extent to which policy has been eased, the extent to which fiscal stimulus had been put in place, and the extent to which the Federal Reserve expanded all of its lending programs to provide backstop to not only banks, which traditionally they had been concerned about, but money market mutual funds, primary dealers, foreign central banks. It's unheard of. And to me, that coupled with a balance sheet that coming out of the 2008 crisis of something like $4 trillion, which was substantially larger by a factor of 4 from what it was before the crisis, to now seeing it at over $8 trillion is just, there's nothing like it.
Does it worry you?
Oh, absolutely it does, in the sense that it's easy to sort of say, oh, look what we did, the economy's doing well. But you're not out of the woods until you've normalized the balance sheet and essentially took the Fed out of the business of monetizing a substantial portion of the federal debt. And that, to me, is where the rubber hits the road.
So we're in a 100-year pandemic.
Yep.
The metaphor is the 1918 Spanish flu. One could argue, Neil Ferguson has argued, we should also look at the 57-58 Asian flu, because it was a big deal, although it didn't make the kind of headlines the Spanish flu did. If we say this is a worldwide shock,
Right.
how does the Fed make a decision in the face of a worldwide shock when it's not a normal business cycle?
Well, 2 or 3 things come to mind. First of all, the U.S. economy still is largely a domestic economy. We get a lot of goods and services from outside, but as a proportion of GDP, it's still not a huge number. Having said that, exports and imports do make a difference in terms of how the economy grows. And so if the rest of the world is lagging and experiencing shocks themselves, then that translates into slower growth, other things equal, for the United States. But at the same time, it's not obvious that the United States has the responsibility to bail out other economies either. That's not really what we're talking about here. But the growth potential obviously is lower if, in fact, a major portion, or a portion, accounts for around 13% of the economy, thereabouts, exports and imports, are lagging.
What was the Fed, what would be the Fed's role today versus waiting till this spike of COVID is over? Why shouldn't they wait? We flew up here from Florida today.
Right.
140 people died of COVID in Florida today.
Right.
The news is terrible. And we're in a political environment in Florida where public health gets caught up in politics and people are dying.
Well,
how do you deal with monetary policy in a scheme which isn't designed for those shocks?
well, I mean, first of all, the Fed is not in the medical business.
Agreed.
That's so. Essentially, their third-order impacts really trying to cushion the economy from the negative effects of the shock. And given the fact that there's no history upon which they can rely to make decisions, uncertainty is the name of the game. And by uncertainty, I draw the distinction between that and risk. If risk means you have some idea of what the probabilities of outcomes are, uncertainty is you don't. And in the face of uncertainty, I think what we're going to see is the Fed's going to wait. They're going to wait until things get to the point where they can't wait any longer. Now, don't ask me how long that is.
I'm not, all right. We talked about that on the plane. All right. Norm is telling us we're already past the time of the YouTube, but we're going to do one more question because he doesn't have a choice. He has to record it. So we talked about on the plane how you make this difficult decision. And we agreed it's a difficult decision.
Right.
So I asked you a question. Let me ask it for all of our viewers. If you were the czar at the Fed and you could change the short-term interest rate target rate today, what would you set that rate? What would you do today?
First of all, I would try to communicate to the public what's being done and why. And in this particular case, I think it would be prudent, because of what we've seen on the inflation front, to at least raise the target rate by 25 to 50 basis points over maybe a course of 2 or 3 meetings, just to get things started. Will that happen? I doubt that it'll happen, simply because I think the Fed is scared to death about how markets will respond, keeping in mind the past situation when they started to move interest rates and the market's got to go all excited.
So the fear of the taper tantrum is there.
That's what I think.
Yeah.
And that's the lesson that they've learned, and they haven't figured out a way to get out of that box.
Well, I suspect in between fishing, and you're an experienced bass fisherman, I know it, now everybody else is going to know it. In between fishing, we're going to talk about this up here many, many times.
Well, I think everybody's going to have different views, and it'll be interesting because this is a very diverse and very interesting group of people that we're meeting with.
So for those who don't know, Bob Eisenbeis and I have known each other a long time. He is on the board of Cumberland Advisors. He's our chief monetary economist and has been with Cumberland since he retired, and we said to him, come join us and you don't have to do anything you don't want to do. Isn't that true?
Yes, that's true.
And it's been the best run we've had for a long time. Thank you, Bob.
Thank you.
And thank you, Norm, for starting us off together.
So not to fill it up too fast?
Yeah.